So let's begin. So I did some research, and you are originally from Paris, if I'm not wrong, and your
Hmm.
parents were business owners, or they, and your father was a hotel manager, if I'm not wrong. So then, how
Correct.
did you
Yes.
drift into venture capitalism and business and tech in general?
So my father was a hotel owner. I mean, he managed the hotel, but he owned it, and so he was very much an entrepreneur in his own way. And I'm an entrepreneur too, and I 100% took that from him. I think in many cases it's a family thing. So I that's half of the story. Half of the story is growing up, seeing your parents, because both my parents, of course, worked at the hotel, being responsible for their own business, earning their living, struggling, working hard, not counting the hours, taking the risk, always sacrificing, always, and it kind of becomes second nature for you. And so that was for me. So I knew I wanted to be an entrepreneur myself. And the second half of the story is, of course, tech. And I started with video games. I loved video games as a child, and then I started playing games like, let's say, Counter Strike, on PC. And then I was like, okay, how can I build maps for the game? So I started, okay, so that's how, and then how can I host the servers for the game to host my own games? And little by little, I kind of discovered the internet and technology and digital stuff. I loved it. And so then I kind of merged both of them, like the tech side and the entrepreneur side. And I went to startups, and I've never been happier.
Yeah. So actually, you mentioned then that you got interested in making maps for games. So why did you not like go deep into and just start making games and instead like start building maps? What was that for?
Uh, for me, it's always been, you know, so first, I guess, I mean, I was much younger, I was like 15, 17, 20, around that age when I played a lot. And I never thought of it as a career. I used to go to school, and then when I come home in the evening, that's my fun time. But I never thought of it as a career. And at the time, video games, I mean, today, video games are a huge industry, and it's a legit industry. It's a career choice. It's a very reasonable, and can be lucrative career choice. And you also have options for indie developers. Uh, in the early 2000 or late 2000, it was not the case, right? Video games, I think the first game whose budget was bigger than the movie was the King Kong game by Peter Jackson, and that was, I think, 2004. So I was 14 at the time. So yeah, never, it never struck me as something I could actually do as a career. And I think I enjoy it more as a fun thing. I wouldn't want to make it my work. Still today, I love playing games when I'm done with all my work. So it's kind of two separate worlds for me.
Yeah. So you did not think of it as a career, but what made you think that OpenVC, which is actually in a nutshell like a database for all of the VC funds out there, what made you think that this would be the
Mhm.
right fit for you?
It was, so I've done many things before OpenVC, right? I've done many, many things. And I think I have built the skills and the, let's say, connections or network or experience to make me a good fit for OpenVC, because I think it's kind of a journey. And so I've worked in the US, in San Francisco. I've worked alongside many famous like VC names. I've worked with startups as well at Microsoft Accelerator in Paris. So I've helped startups, and I've received deal flow. I have founded a startup before OpenVC. I've raised funding. So I've seen both sides of the story. And so I knew the pain points. I knew how the industry works. I didn't know everything, of course, and I still don't. But I felt that I I saw things, and I understood things, and I could help. I thought that, okay, there's an angle I can take that nobody's taking. I felt that there is this opportunity, and I was really surprised because when I thought about OpenVC the first time, I was like, this must exist. Somebody must have built it already. and I couldn't find anything like that. So I was really surprised. And I guess that's my answer, is that I built over my past years of experiences, I've built confidence that, okay, this is needed and doesn't exist, so I should build it. That's
Now
pretty
you
much it.
said that you worked at the Microsoft Startup Accelerator. So how did that go about?
Hmm.
I mean, how did you get into Microsoft?
So for context, so this was in Paris, my first real job after business school, and Microsoft had this really cool accelerator program for startups, and so every 6 months we would select 10, I think it was 10 startups for 6 months. Usually, they already had raised like pre-seed or angel round, going for seed or series A, and they were all like in cloud at the time. This was the time when AWS was huge and Microsoft and Google were running after them, and they didn't know really why they had this accelerator program, but they knew they had to have one. So it was half, you know uh, out of imitation and half out of desperation. And they built this. They really invested a lot of money into this program. It was great being in the middle of that. And yeah, we've done a lot of work trying to help those startups go to market and raise funds. These were the two things we've done, right? Going to market with Microsoft clients, helping them access large corporate clients, and raising funds in Europe and in the US, again leveraging the Microsoft brand, the Microsoft name and network. I've done that for over a year. I had an amazing boss, Pascal, a great guy, fantastic guy, and um, and this is really where I got knee deep into the startup world, and I realized, okay, man, this is awesome. Like, how is it even possible to get paid to do that? I had so much fun every day. I learned so much every day, and I was still getting paid. And so, yeah, I said, okay, that this is really what I want to do. I want to do something in that space. So,
So how did you get into OpenVC from the Microsoft Accelerator?
okay, so Microsoft is where I had the idea for the first time of OpenVC. I was like, okay, I'm in a co-working space, in the accelerator with 10 startups. They're all looking for investors, and there is no like reference database that they can go to, right? Not one that is really actionable and built for that use case. Of course, there's Crunchbase and others, but they're not built for that. You don't have access, you don't have direct access to investors. Then after Microsoft, I moved to the US. I've worked for a couple of years in San Francisco um, for a firm called Faber Novel, kind of acting as a middleman between tech startups in the Bay Area and large corporate players outside of it. Again, super interesting, learned a lot, and got deeper into how to build a startup, how basically this whole relationship driven ecosystem works, because that's really the trick and the tricky part about what we do, turning relationships into a product, which is really hard. And eventually when I came back to France, I've done some more stuff, and the idea came back, and I said, okay, now it's time to build. And at the time, 2020, no code was big, right? No code was really emerging, and it was like, okay, now I can build it, and it's going to be 100 times cheaper and faster to build. So that's how I went from it. It was not a direct thing, right? It was not from Microsoft to OpenVC. It was Microsoft to Faber Novel in San Francisco, back to Paris with another startup, and then finally OpenVC. So it took a bit of search to get there. So it's like 5 years. It's like overnight success, 5 years in the
Yeah.
making. You know.
Why did you decide to create a kind of database for venture capitalist funds, VC funds?
Because I felt it was needed. I felt people needed it. For 5 years working in that space, I mean, more now. It's always the same question: who invests in? I speak with, let's say, a biotech startup in Singapore, raising seed. Do you know who invests in biotech startups at seed stage? Right. And then I go to Germany, talk to an e-commerce startup, same question. And it's always like the same starting point. Hey, who invests in what we're doing? So it was weird for me. Like, there's Google, but Google doesn't give you any answer on that. Not good, not great answers. Crunchbase, again, is not built for bringing deals. So I felt like, it wouldn't be difficult. So one thing is, I felt it was needed. And number two, I felt it was easy because I felt, yeah, let's build it like Wikipedia. I don't need to charge. I don't need to charge people. People will not pay for it. It's just open. People can sign up, add their funds, or if they're founders, they can, check the lists and search funds, and that's it. And we'll see how it goes. So it started as a. By the way, I didn't start full time on it. It started as a side project. So just building this on nights and weekends. Um, and then later on, I met my co-founder Lucas, and now we're building OpenVC together. Because I'm not a tech guy, he's the tech brains, right? I mean, he's a big brain. I'm just the idiot guy running around and putting out fires. But he's the real brains. But yeah, it's not like I had a plan. I didn't have a plan. I was like, okay, this is useful. This is doable, like even just by me alone. And so let's try. And then it just grew organically. That's pretty much the story.
Yeah, I guess the story is very interesting. But like you mentioned about like you gave a Singapore example. So I think in general, education regarding raising funds is very, very bad. No one teaches you how to do that. You don't learn it anywhere. So I think, and that's why warm intros I think are more prevalent rather than just cold outreach, because people don't know how to reach out to investors in the first place. So you're going.
Oh yeah, yeah. No, just to I completely agree with you. So I think there are two things, right? One is investors are over solicited. Anyway, they have like 1,000 startups for one investor. So the easiest way for them is just to rely on recommendations. It's human. It's not that they're bad people. It's not that they're lazy. It's just rational. Why would I look at 990 pitch decks that are very uncertain and probably bad when I know someone I trust will bring me the tapped on ones? So that's the first half of the story. And the second half, as you said, founders suck in general when it comes
Yeah.
to reaching out to investors. They just don't know. Like they don't have the playbook. They've never been trained in that. They don't know how the industry works. And so yeah, they just make all the mistakes and they don't realize it. And so of course investors will not reply. That's just natural. And especially within all those founders, you always have like 1% or 2% of founders who are incredibly bad, incredibly pushy and aggressive. And so when you're on the investor side and you receive those guys and you just say, okay, let's be open-minded, let's review and talk to some people. And you have a few of those guys. It's like after that, you're like, any cold email I receive, I stop looking at it because I don't want to. Why would I, go through this kind of like shitty behaviors and shitty people? It's not worth it. It's not worth the effort. It's not worth the trouble. And so that's also what we try to do at OpenVC, right? We have our software product, we have the platform, and we also have resource and webinars and courses and trying to teach people and to educate people about how to do those things, right? Don't be emotional about it. Don't take it personally. Prepare, research, customize, be smart. Yeah. So it's a yeah, it's a whole lot
Awesome.
of work.
So a lot of people might be watching this episode are starting out on the journey. So like tell me the exact or the real life process to raise funds as a seed startup and and at the growing stage.
Okay. Um, so first thing, of course, no two startups have the same path to funding. Because in many cases it's kind of an organic process. I know many founders who had the kind of funds committed before they start the startup, because they have track record, because the way the idea appears or emerges is in a context where investors are already in the loop even before they start. But in general, the first thing is make sure you are fundable. Okay. So number one, make sure you're fundable, which means if you are a software startup, you're probably fundable. If you are doing retail or doing services, you're probably not fundable. VCs don't invest in uh, low scalability businesses. And if you're biotech or hardware or something in between, you might find investors, but it's difficult. And then the step two within fundability is how are you ready or are you too early to raise funds? A lot of founders, they're like, okay, I have this idea, I need cash, I'm going to raise funds. But that's not how it works. The right order is, I have this idea, I build something, I show enough validation, I show enough traction that investors will get excited. And that's when I can raise. So you don't raise when you need money. That's the big mistake. You don't raise when you need money. You raise when you're sexy. You raise when you look good. And a lot of people, either they don't just have no idea that they just say, I need the money, so that's the time to raise funds. Huge mistake. Or they are not capable of seeing that they are ugly. Right? It's like when it's your own baby, you don't see that it's ugly because it's your baby, right? Your baby has to be cute. And so the same way your startup is cute, but it is definitely not, because it's a competition. So maybe your baby is ugly, compared with your neighbor's baby. But when it's a competition and I see 10,000 babies per year, then yours is maybe, in the bottom, bottom 50%, but I invest in 5 babies per year. So that's the reality. And a lot of founders, they don't realize that because nobody tells them. So the first step is make sure you're fundable. Okay. And once you're sure you're fundable, then we go with step 2, targeting the right investors. So build your investor list, and you can find investor lists out there, 200, 300,000 names on it. But actually, you have to filter it, right? Filter by geography, by stage, by industry, by vertical, by check size, right? All those things. And you will end up with 100, 200 investors who are actually good fits, right? People who invest exactly in your scope, right? In your thesis, at your check size, in your country, right? This is the list that you need. You don't need 10,000 people. It's not a numbers game. You're not doing like, mass emailing to sell, I don't know, to sell some whatever product, right? Because your market, right? Your total pool is not 1,000,000 people. You have 100 people. So each of them, you have to go very carefully, in a very customized manner, and you're going to reach out to them. So the way you're going to reach out to them first is, if you can, get an intro. It's always better. That's number one. If you cannot get an intro, you're going to try to have them contact you through inbound. So you're going to be active on LinkedIn, on Twitter, where those guys are, comment on their posts, make sure they see your content. And because they are a good target for you, because you've done your homework and you know they're good targets, they're going to notice what you're building and they're going to reach out to you. Okay. And then after all of that, you should have hopefully 20, 30, 40, 50% of your round already secured, right? You met those guys, they either sign a safe or give you a term sheet. And you have, 30% of the round. So you don't have your whole round yet, but you have enough momentum. You're exciting enough that you can cold email the rest, right? But cold email or cold outreach comes at the end. So you can do that through, of course, emails, or you can do that through OpenVC, which I think is better. That's why I built it. But a lot of people raise funds in different ways. So not here to say we're better, but I think we bring a few cool things to the conversation. And you're gonna contact those investors and tell them in a very professional manner, hey, this is who we are, this is what we do, this is why we're a good fit for you, right? We know that you've invested in this kind of startups in the past 2 years, and what we're building completely makes sense for you because there's a fit, right? And then here's the deck, and do you want to get on a call next week? That's it. And you make it less than 1,000 characters. Your deck, 12 slides maximum, high level view, very visual, no need for details. You're just trying to get on a call or get a no, right? It's either get on a call or get a no. That's all you need. And that's it. And after that, I mean, we can go into much more technical stuff. I can show you templates of pitch decks. I can show you templates of cold emails. I can show you like detailed, frameworks about how to do all that stuff. But, it's fundability, targeting, and accessing the investors in that order.
Yep. So in the very well explained, by the way. But in the first step, you mentioned that you get idea, you get validation, and you raise funds. But mostly we see in pre-seed startups, they get idea, raise funds, and then validation.
No, that's I think that's not how it works. Unless, so the only case this works, the only case where you can get funding before validation is if you have a strong track record, right? So let's say that you are, I don't know, Mark Zuckerberg, right? Starting a new startup. You don't need to have a product. You don't need to have, just say, hey, I'm Mark Zuckerberg starting a new startup. Who invests? And you're going to get checks, right? But this happens actually quite a lot. A lot of people who get funded are repeat founders. But for your first startup, if you're first time founder like most people, it's on you to get to the first, like build a little prototype, little MVP, get some users. And I'm not saying you need to have, $10,000 per month in recurring revenue, but you need to show something. You can not just show up with a pitch deck. I mean, you can try. Some people, succeed at that. Some people are really good at telling stories and basically bullshit their way to funding. But I don't think it's realistic for most people. So if you really want funding, basically build, grow, and then funding will come in due time. But you shouldn't expect funding to build. And I think it's a message I keep repeating because people have the idea, as you said, they put the cart before the horses, so it doesn't work. And then they're like, hey, I cannot raise. Why I cannot raise? Why is it so hard? Yeah, it's hard because you have nothing to show. I mean, if I show you the deal flow I see, right? You have people, like I have like 5 to 10 decks per day, right? And 8 people, they just have an idea and a nice pitch deck and maybe a few how do you say mock-ups, right? Like designs. And I have one guy, he's already make $5,000 a month. He has a team of 3 people, clients in 5 countries, and they're all asking for $1 million. Who gets the $1 million?
Yeah.
So again, it's a competition. You're selling a product. Your product is your equity. Your startup is selling on the market. It's a market, so there's supply and demand. And if your supply is not sexy, there will be no demand because you're competing against people who have revenue, people who have track record, people who already have half of the round filled. You receive an email and the guy tells you, hey, I already have a term sheet from Sequoia or Partech or whoever. Yeah, seems pretty good to me. So yeah, again, I think a lot of founders just don't see what happens, in the mailbox of the investor. And if they could see that, they would, think differently. They think, okay, I need to be stronger before I try to raise, before I start playing that game.
And how can they become stronger? By validation and by
validation. Show that the market wants your product. So it's easier said than done, and depending on what you build, it's going to be different. It's going to look different. If you're doing a simple, piece of software, it can be easy to build, even using low code or no code. If you're doing hardware, it's going to be much harder. If it's consumer hardware, maybe it's going to be through, crowdfunding. If it's B2B hardware, honestly, I don't know how those guys do. If it's biotech, you like a new molecule, new drug, it's going to be through it's going to be through studies and through the quality of your board of advisors and your scientific board, these kind of things. But you have to show that basically a startup is like a box, right? And you want to put as much valuable stuff in the box before you want people to invest in it, because it's going to make it more valuable. So advisors, validation, revenue, partners, anything of value. You cannot just say, hey, the box is empty, put the money first, and then I'm going to start filling it. Yeah. Surprise, it doesn't work.
So at this stage, do you look at the founder or the idea or whatever the product the founder is building? What do you look at in order to invest? Apart from the validation, of course, because that's a necessity.
Yeah. So myself, I'm not a huge investor, right? I've done a few personal, cut a few checks on personal level, but I'm not an investor myself. I serve deal flow to investors, to thousands of investors through OpenVC. So I have to be very aware of what they want and what they look at. So there is a baseline. Everybody looks at the same things, and then there are specific stuff. So the baseline, everybody's going to look at the team, of course, because the team is the only thing that will never change. Maybe the product will change, the market will change, the distribution will change, but the team is the one constant thing in a moving world. So that's the first thing you're betting on. Then after that, you're going to look at the co-investors. So that's not me, but a lot of investors will ask, okay, who else is investing?
Yeah.
Because they are very gregarious in how they think, and they love following other people because they don't trust their own judgment. That's basically how it is. So who else is investing? Traction, how much revenue, but more importantly, how fast revenue is growing. So if you're a SaaS startup, are you growing 10%, 20%, or 30% month over month for 6 months, something like that? Traction can have, of course, different aspects. Let's say your social media platform, it's not going to be revenue, it's going to be recurring, active users, this kind of stuff. I mean, active users over a significant period of time. So yeah, team, traction, product. Funnily enough, I think nobody really looks at the product unless you're in hardware or in biotech where product is key. But when it's software, nobody really cares because we know the product is going to change 10 times and evolve 100 times. So that's not really something. And that's another big difference between founders and investors. Founders always talk about the product. Hey, we have this feature and we have that feature and we're building that integration and we have this amazing new, UX or UI coming up. Investors couldn't care less. Like they don't care. And when you cold email an investor and you make a list of all your features, they don't care. Like explain the product in 2 lines and then focus on, your team, talk about your team, talk about your traction, talk about anything good about your startup except the product, because most investors don't care about it. And when I say most, I mean 90%. So yeah, I think that's really what I see. I see the most: team, traction, and co-investors. Yep, sounds about
Now
right.
you said that investors don't care about products. So why don't they care about products?
Yeah,
Because that's the thing which is going to make the money action for everyone.
yeah. So I think it's a good question, and there are probably several answers. Number one, the product will change, especially in software. It's so easy to build and to change that it's not worth, especially at early stage, it's not worth spending time testing and reviewing the product because it will evolve. And number two, in most cases, the product is not the key to success. Right? Any software product can be copied. I could copy Airbnb or Uber software, right? There is nothing special about it. What matters is the brand, distribution, maybe some, virality or a network effect in it, but time to market. But the product is kind of the least important piece of the whole puzzle, right? So yeah, it's something, it's going to change and it's not critical. The product, and again, because founders spend their time building the product, they don't feel that way. But I mean, we can all think about many products that are really bad but sell really well. I mean, it's just how it is. Product is overrated in founders' mind, and so yeah, that's not what investors really care about. I also think that a lot of investors don't have a product DNA. A lot of investors are more, how can I say that? Like network people, connectors, maybe finance people. They are not so much about the product. They're not so much about software. Not many of them have built before. I mean, this is changing, but not many investors were makers actually or builders. A lot of them, they live more in Excel than in Figma. So that's another thing. It's just not their sweet spot. I've met a few investors who are actually real product people, and it's a
Yeah.
completely different conversation. They try the product, they give you feedback, they actually give you tough feedback, and you can tell they love what they do and they understand. And it's absolutely lovely when this happens, because the conversation is very satisfying for the founder, but it's very rare. In my experience, this is not most investors.
Now, what is the role of an investor? Like we get investors on, but it's not their only role. is not to provide money or capital for the startup. What else role do they play out there?
Are we talking about angel investors or VC investors
Both.
or what
Let's
kind
talk
of
about both.
investors? Okay,
Yeah.
because it's not the same answer. So I'll start the angel investors. That's the easy answer. They are individuals who have money. So they are people like you and me, right? If you invest 5K in OpenVC, you're an angel investor in OpenVC. And so usually you do that either to have fun. In most cases, just to have fun, right? Because you like what I do and you want to support it, or because you expect some financial return, but you know it's very risky. So usually you have some stocks and real estate and bonds, and you do a bit of startup investment just to take a bit more risk. But again, it's because it's fun. I mean, some people do crypto instead, but it's kind of the risky in your portfolio management as a rich person. Startups and crypto, they are up there in the risky bets, right? And you have your and they're like 5% of your bets, and the rest is like serious stuff. Or it's for tax optimization. That's when you're an angel investor, right? That's what you're doing. Okay. But those guys, angel investors, they are not who we think about. Who we think about in general is VC firms. So they are companies or entities, corporations, um, whose like sole role and purpose and raison d'être is investing. So the guys who run that, they're called the partners, general partners, managing partners. And what they do, they have, let's say, three roles. Role number one is raising the money, because they don't invest their money, they invest somebody else's money. So you have the fund, and above the fund, you have the LPs. I'm making it very simple. So the LPs invest in the fund, and the fund invests in the startups. So you have two layers here. So the fund, their first role, even before investing, is getting the money from investors, from bigger investors. And this is super, super hard. I think it's fair to say it's much harder to raise money for a fund than to raise money for a startup. So, when the founders, they feel frustrated, like, hey, it's very hard to raise money for my startup. Well, but the VC had to struggle 10 times more in general, on average, to get the money for their fund. So that's the first role. The second role is investing in the startups. So they select, they find them, they select them, screen them, like execute the transaction. And then the third role is supporting the startup. So after they invested, that's what we call portfolio management. You have startups in your portfolio. How are you going to support them? Help them connect with clients, connect with their next investors, hire, all that stuff, expand internationally. So some investors help a lot, some don't help at all, some even create troubles for you. But in general, most funds try to be helpful. It's what we call the value add. So I remember in 2016 or 17, when I was in San Francisco, Andreessen Horowitz, they're a very famous VC firm over there. They had, I think, 150 full-time people just to support their portfolio companies. So if you're A16Z startup and they invest in you, you know that you're going to have some serious firepower to help you, build, grow, scale, and exit. And this is great, especially if you're like, let's say you're a technical founder, you're a tech guy, a science guy, you don't know business, and those guys say, hey, we have the business muscles, we're going to help you with intros, we're going to help you with your finance, with your HR, don't worry. So this is the third part, helping the startups, right? Raising the funds, investing, and supporting the startups to an exit, because once you have invested, now their success is your success. So you want them to succeed, of course.
And while raising the money at this stage, how is the valuation decided?
So what's talking about is
Yeah,
what's called
pre-money
pre-money
value.
and post-money valuation. Uh, but this is not really the difficulty here, because this is easy to calculate, right? You have a pre-money valuation, you add the amount raised, and you get the post-money. So this one is just very easy, and everybody agrees on that. The challenge is, how do you decide that number? It's market. It's free market, baby. So it's supply and demand. So if I tell you, hey, I'm raising, I'm raising for OpenVC and our valuation is $10 million. If you invest, then our valuation is $10 million. If you don't, and I find another guy and he invests, I tell, hey, now it's $6 million. Yeah, maybe he invests now. The valuation is six. So at early stage, honestly, it's just whatever people want to believe, and how much, as long as they put money in, that's the valuation, period. So Then, of course, there are, let's say, reality checks. Okay, so for example, um, a founder will have a threshold, right? It doesn't make sense for a founder to get diluted too much. If I raise $1 million at a $2 million valuation, I've lost like 33% of the company post money. It doesn't make sense for first round because I have nothing left. I'm already too diluted, so it doesn't make sense. If no, sorry, 50%. So it doesn't make sense. Not 33. If I so that's the founder side. So the founder side is going to look at how diluted I get, and doesn't make sense. So for example, you want to keep at least all the founders should own collectively at least 50% of the company after Series A. That's kind of the so you start from there and you walk backwards. Okay, if I have to own 50% plus one altogether at Series A, how much can I give away at seed? How much can I give away at pre-seed or angel round? That's the founder perspective. And then the VC perspective is how much do I want to own? So as a VC, usually you have kind of target, you want to own 15 to 20 to 25% of the company. Because in case of an exit, you want to have enough upside to return your fund and then some. So that's like everybody has their own number in their mind, and then throw it at the other party, and they see if it works. That's kind of how it is. It's not a transparent market, so there is no um, efficient process like pricing finding process. It doesn't work like that. It's more of a discontinuous process.
So how how do you advise the first time founders to decide the pre-money valuation?
So you're going to look at comparables. You're going to look at, okay, I'm a social media startup in France. I'm raising pre-seed. I have a product, no users. Okay, my team is nothing special. We don't have a super strong track record. We just first time founders. So you're gonna lose a lot of equity. That's for sure, right? If that's all you have to show. And you're going to look at other startups, similar stage, similar industry, similar geography, and you're going to see, okay, so on average, it's 3, 4, 5 million pre-money, post-money. Doesn't make a difference at this point. It's going to be, let's say, 4 million. Okay. Now I'm B2B SaaS startup. I have $1 million in annual recurring revenue. I'm based out of Seattle on the West Coast. So yeah, it's gonna be 10, $15 million, and you ask around and you try to compare yourself, and then you speak with investors and you announce your valuation. You see if that works. And by the way, you don't want your valuation to be too high because it can make it difficult to raise the next round after that. So it's in your own interest to find a reasonable number, and it's a VC's interest if they like what you do and they want you to succeed. They will accept. If investors really like what you do and believe in it, and your valuation is reasonable, usually they will not. They will not, negotiate that much over that because it's not worth it. If your valuation is crazy, they will pass. Or they'll tell you come back, for the next round because it's too high for us. But I don't find that this is the main issue. I find the issue is more finding people who believe in what you're building. If they believe in it, and if your valuation is reasonable for the market, which is what you should aim for anyway, then it's going to be a pretty smooth. This is pretty standard. Once you reach that point, it's pretty standard.
Yeah, so there's no like preset formula or anything for calculating evaluation.
No. Now, there are many formulas. They don't apply to startups. The real formulas, the finance formulas, DCF and all that stuff, it's for later stage companies, right? When you have actual cash flows, like real valuation and all that stuff. When you're early stage, I think when Mark Lower started so this is the guy who his startup got acquired by Amazon, and then he left to build another e-commerce startup, Jet.com. It was Jet.com. I think the valuation pre-launch was $1 billion, like pre-launch, because the guy is Mark Lore and he knows what he's doing, right? He was considered the second best like e-commerce guy in the world, and number one was Jeff Bezos, right? So that's why I'm saying there is no formula, because for those things there's no formula. And sometimes, by the way, you bet on a guy like Mark Lore and it's a failure. If you think about Theranos and Juicero and all those famous startups that had huge valuations and completely flopped. So
like WeWork.
Yeah. Yeah, exactly. So I think valuation is not, honestly, it's not what you should focus on as a founder. You should know what a reasonable, you should have a range, right? And this range you can, discuss it with accelerators, with advisors, with other investors, and just make sure you're comfortable with it and understand what it means for you. But it's not harsh. I mean, it's not tricky. It's not like you're gonna fight over a percent with the investors. It's not like that. If there's trust, and if they're gonna, okay, what I'm trying to say is they're going to challenge you much more on the value proposition, the traction, the team, the positioning, the competition, differentiation, unfair advantage, all that stuff. And if you pass all those filters, at the end of the day, the valuation is going to be, okay, that's the price for the startup. Let's just do it, because all the rest is so hard. This is what we really care about.
Yeah. I mean, so what do you think at the current stage? Is it hard to raise money, or is it relatively easy compared to previous years? Yeah.
Right now, yeah, it's harder.
So, yeah.
It is harder because people think it's harder. So it's kind of a self-fulfilling prophecy. Some people are actually impacted, yes, of course, by the downturn. There's no exit. So since there's no exit, there is no investment at later stage, and then it kind of trickles down or trickles up all the way to early stage. But I also know a lot of people who have money and are not affected at all, but they're just scared. And when people are scared, they wait, because when you're scared, you'd rather not move, right? It's a natural behavior. So half of it is actual financial impact and half of it is psychological, but it's always the case anyway. So yeah, it's harder, and the great projects still get funded. But as remember what I said earlier, right? If you have a killer team, strong traction, and some investors already committed, you will close your round, no problem. But other than that, for unproven teams or projects that don't have super strong product market fit, product that would have raised before but a bit tricky now, it's much harder for them. It's kind of like the bar is higher, let's say.
And what do you look for in a killer team? Like, for example, in a
What
killer
do I
team,
look for?
an amazing team. Because, for example, let's look at CTO of the startup. What all would you look in him? And CEO of a startup, what all would you look for in him? What skills or what?
Yeah. So I think there are many signals that investors look for. One is, have they done that before? So if you have built a startup before, sold it, or IPO'd it, and you're starting a new startup, fantastic. You've done that before, so we're confident that you can do it again. You're more likely. Actually, there is a book called, I think it's Super Founders. I forgot the name of the author. I should find it. And this guy has done a huge work. He's researched all the data about unicorn founders and found that one of the most consistent aspect was, I think 60% of the founders who founded a unicorn startup, so worth over $1 billion, it was not their first startup. It was their second or third or fourth. So it's the best indicator of success, apparently. I mean, we can discuss that. Some people disagree. Would be, being a repeat founder or an exited founder. So that's number one. Another one is the founder market fit. We always talk about product market fit, but there is also founder market fit. So I'm a founder. I'm going to build. So, when I started OpenVC, we discussed earlier, I know the venture space, I know people, I know the market, I know, how those things work. So not that I'm an expert, but I understand it at a deeper level than the average person. And so I can make some relevant propositions for it. If you're fresh out of business school and you don't have that experience in that market, what what unique value can you bring? Nothing. And so the same thing. If I want to start something in biotech or fintech, I've never worked in finance. I've never worked in biology. I'm not the right person for that. So the second point we're going to look at for a team is, do the founders have strong, deep expertise in the space? Because if you have that expertise, if you have that experience, if you have worked 5 years, 10 years, 20 years in a space, you're more likely to see things and understand things that other people don't see and don't understand. So it gives you an edge. Keep in mind, the objective is always to have an edge, have an advantage over competition. So how can I get that? Well, I get that because I know stuff and I know people that other people don't. That's number two. And number three, I would say, and I would stop there, about the founding team. You want the team to be to cover all the key areas of the startup. So, for example, one CEO for business and one CTO for technology, right? You don't want a team. Sometimes we see that it's cute. You have 4 or 5 guys, they're all friends, right? All out of business school, so none of them can code, none of them can build a product, and they all start a startup together. So you have 5, mini CEOs. That's 4 too many. So actually, and it usually doesn't work. So you want a team that has all the key skills, and ideally people who know each other and have known each other for a long time and worked together and done hard things together. So, for example, recently I spoke with a great cybersecurity startup, and so the 3 co-founders, they used to work before. They have worked before for 5 years in another company, very successful there, and then they're like, okay, we have this idea. We have worked together. We know each other. We know how we work. We've done really hard shit together. We succeeded together. So now let's leave the company. So they all left together to build a new startup. And that is great because those guys, they know each other in a business context. They value each other so much that they're willing to jump together, jump ships, and start something new. So this is another strong indicator. They've done things together, hard things together before.
So, in this whole equation, what role do advisors play? Like, do the investors look for advisors? Like, if there are some good advisors, will it increase your chances of getting good funded by good VCs or something like that?
Yeah, it can. I mean, so I have mixed feelings about advisors. I think the best advisors you can have are angel investors. So today it's very easy, much easier than 10 years ago, to bring in people who will write small checks and support you. It's very easy. So if I want to start tomorrow, I don't know, hardware startup, I could very easily go to 10 hardware experts and have them all invest just $1,000 each. And because they have invested money, they will support me with their network. And so the role of the advisor, we just published actually a post on advisors. Maybe that's why you asked the question. I don't know. The role of advisor is very diverse. Can be advisor about the product, about the go-to-market, about raising funds, about strategy, anything else. So it's hiring. It can be really anything. It depends on your needs. But in some cases, you're gonna give them a bit of equity, like 0.5%, vested over 2 years. But in most cases today, I think it's much smarter and better to have them invest. So they give you money, they give money to the startup, and then they help you because as investors, they are incentivized to see you succeed. Should advisors help you raise funds? They should help you raise funds, but that should not be the main focus, right? I would be uncomfortable if someone tells me, hey, I can connect you with VCs, but you give me 1% of the company. This for me is predatory behavior. So you don't want that. I mean, That's not how this game is played. So don't give people equity to introduce you to investors. You don't need that, and it's not going to be successful. You can, I mean, there are some people are fundraising advisors, right? And they charge for that service, and they're going to charge you a percentage of the fundraising, which I guess is fine. But usually this works if you're raising over, let's say, $2 or $3 million, right? Under that, financially, it doesn't make sense for those people to work with you because the reward is too low. But yeah, so that's my answer. I'm not sure it was the question you asked, but
Now
that's my
you
answer.
talked about angel investors there. Do you think that angel investors look at founders the same way as fund managers or VCs do?
No. So they look less professionally and more personally, more humanly. Angel investors are like, hey, do I like this guy? Do I want to hang out, have a beer with him? It's more of a personal relationship. Do I trust him? And VCs will ask those questions, but they'll also look more closely to your financials, to your business plan, to your strategy, because they're not investing their money, they're investing someone else's money. So they have to report and they have to explain. If it's a bad investment, they will have to explain why. If it's an angel investor, if I invest, 10K per year in 2 startups. If I lose 10K. If I invest in startups, I mean I can afford to lose it, and it's my money, so I don't have anybody to report to, right? I lost the money. That's it. Uh, so yeah, it's not the same angle because it doesn't come from the
But
same
if
place.
you talk about like kind of losing money, so SoftBank, we take for example, Masayoshi Son. So he raised $70 billion for, I think, the Vision Fund, and he blew a lot of money into like WeWork and startups which then kind of crashed. How do you think so they have to justify it to the uh, limited partners who are not found?
Yeah. They wrote off most of the fund. Yeah, I mean, or big part of the fund. Yeah. uh, I mean, it's a different story. This is, what happens between startups and VCs is one thing, and between VCs and LPs, especially at that size, is a different story. I'm not. I don't really have any thoughts on that because it's far from my. I work with small startups, in the very early stages, so I don't have really anything crazy to say about it. Um, it's fun to watch from the outside, and but it's okay. I think they will survive. Those people always find a way to survive.
Yeah.
So
Now we talked a lot about raising money and VCs. Let's talk about investor list. Your expertise. How do you go about building an uh, investor list? Apart from the fact that you look at uh, what industries there is. So the best way to create your own like personalized investor list. Yeah.
how do I build my investor list? So ideally, you start your investor list with names of people you already know, right? So the same way, if you start a startup, you should already know you know them personally, your first 10 clients, right? The same way you should know your first 10 investors because you've worked in that space, you have expertise, you have experience, you have connections. So it's not like you woke up one day and say, "Hey, I'm going to start a biotech startup," and I know nothing about biotech. I know nobody in that space. No, if I start a startup in some space, I already know my first 10 investors. Ideally, you should, right? And that's what happens for most people who succeed. Then after that, I'm going to have people that I don't know personally, but I know by name. So I know if I want to start a SaaS startup, I want Christoph Jans, right, in Europe, or I want Jason Lemkin in the US because they are killer SaaS investors, and I want those guys with me on the right. So I will write their names. And then after that, you need to actively search for people that you don't know. And for that, you go to OpenVC and you type, okay, SaaS, US or Germany, and then you click search and you get the list. And that's how I build my list. So people I know, people I want, and people I find.
Yeah. That's an interesting. So OpenVC. Do you guys have angels and accelerators maybe too?
Yeah. So we started with VCs and then we added recently angels and accelerators. So we don't have many, but we do have some. So, and same as the rest is it's free to access. So if founders want to search some angels and some accelerators, they completely can.
Yep, that's incredible. Do you think we talk a lot about everything that beginner startup founder should know? Do you think there is anything else which they should know before they start? I mean, there are a lot of things, that, of course, but a few things that you think personally are very important apart from what we talked about.
Okay. Okay. So a kind of last thought um, is that if you're going to raise funds and you've never done that before, because if you've raised funds before, you don't need my advice. If you have never raised funds before and you're a first-time founder, you have to understand that there is a million other people like you, and you have to do your homework because most people who will try to raise funds, they will not, they will come unprepared, right? That's the sad truth. And I can say that because I see that, because I am exactly at the intersection between founders and investors. So I see the outreach, I see the emails, I see the pitch decks. And those guys, most of them are not prepared. They haven't done their homework. So and so you will not raise funds if you're not ready. If you're not, as I said, you're not sexy, you're not ready, you're not fundable. So take a step back, take a deep breath. If you had planned to raise next month, maybe reschedule things. Take a month or two to understand exactly what you're getting into, to learn how this industry works, learn the language, learn the people, um, like go deep, right? Go deep because it's a long-term game and it's gonna save you a lot of trouble downstream if you understand how to how to navigate this before you jump in. And then yes, and yeah, another thing would be don't wait for funding to start building, right? You should plan your startup in a way that you can build and grow without funding. And then if and when funding comes, that's amazing. But especially right now with the current situation in the current market, um, if you need funding to just get started, it's gonna be incredibly tough. So don't put yourself in a corner. With a lot of founders, they don't realize that. They don't do that on purpose. They put themselves in a corner. They put themselves in a position where they cannot grow without funding, and they don't have time to. They don't have the knowledge. They don't have the signal, and they want the funding. Like they have nothing to offer. They have nothing exciting, nothing good going on, and they think they do. They just have a pitch deck and some mock-ups, and then they go into desperation. They go into a really really dark place because they are trying to play a game and they don't understand the rules. So I'm just trying to give. It's completely doable if you just do the homework before jumping in.
Um, yeah, but so you mentioned that I think you told it all. I don't know. I don't think I have a lot of interesting questions. So what? So I think we'll take a hard stop here. And what advice do you have
Yeah.
for people who are just starting up?
Well, so if we're talking about fundraising, that's, as I said, is like educate yourself on the topic. So YC School, OpenVC blog, um, Twitter, like as I said before, don't go naked to the North Pole, and then you say, "Hey, why am I cold?" Yeah, you naked dumbass, and people are not going to help you because they don't have time and they don't care about you. So, I mean, maybe I'm repeating myself, but yeah, that's my message.
So I guess this was incredible, and that's it from my side. I hope you enjoyed it.
Yeah, absolutely. It was very fun. Very good questions.
Thank you very
Covered a lot of
much.
things.
Thank you for coming.